Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Deming, Managing Director at KKM Financial, to discuss why sector dispersion has created a challenging environment for asset allocators. Dan, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. Thanks for having me.
Before we get into sector dispersion, I want to talk to you about what you're seeing in the S&P 500 and the VIX. What are some key levels that you're looking at, and what does the VIX suggest in terms of seasonal effects and trends?
Well, right now, Jill, we're seeing the VIX pushing down towards the lowest level in 3.5 years. And even though yesterday we did see it bounce up to 15 briefly with the recovery today, there's continued downside pressure in the volatility space because realized volatility continues to hover around basically one-year lows. We're seeing a short dated realized volatility, which means what the market has realized over the last 10 or say 30 days is compressed, and therefore we're seeing implied volatility, which the VIX measure is continuing to draw in as well, because we're just not getting the daily moves needed to prop the VIX up at this point. So overall, we're seeing low volatility. Historically, the summer has the tendency to put in the low vol period right around the end of June, early July. So we'll see if things start to pick up. Yesterday might be a harbinger that we're going to see a pickup in volatility heading into August.
Let's talk about sector dispersion for a minute here. I mean, really what the challenge has been that the rally isn't broad enough, right? It's concentrated to certain sectors or certain stocks, Magnificent Seven, of course. How is this creating a challenge for people who have to allocate their assets?
Well, it has created a challenge the first half of this year, Jill, because of the fact that, last year we did see the Nasdaq certainly see some mean reversion, and now we're seeing some outperformance this year and just a select few names. But we are experiencing now some broadening of that rally or the strength in the markets. You're seeing the small caps and some of the industrial names starting to show signs of coming back to life, like last week, iPaper, 3M. A couple of names that have underperformed year to date are starting to show, some continued strength here. So that's, I think, a good thing moving in the second half of the year, that we are seeing what appears to be a broadening of the rally that has taken place with the big names in the first half of the year. And also the resetting of the Nasdaq was an interesting dynamic, Jill, as well. So we'll see how that plays out in the Nasdaq moving forward, since the weightings were adjusted a couple of weeks ago.
Right. But Dan, what I think is interesting, if you're thinking about how you're going to deploy capital at this point, it's a challenge because the tech sector has had such a run, and right now we're in the middle of earnings, so you could see some valuation resets there potentially. But at this point, I guess, how much more stretched can multiples get, even though you have to somewhat track your benchmark here?
Yeah. Absolutely. Well, the other factor contributing to maybe the potential for some opportunity would be in the fixed income space, as we're seeing yields pushing up to the highest level in 22 years. So that's an area I think that a lot of allocators are looking at for alternative allocation possibilities, given the fact that as you pointed out, the stretch valuations in certain names. But the economy is generating much more strength here than what many allocators thought going into this year. A lot of people, I think, were caught off guard, and to some degree, so were we. We thought by this time we'd start to see rate cuts as we headed into this year, and that's just not going to be the case. So that's another factor contributing to the challenges, but also some opportunities.
Yeah. Well, let's talk about that for a moment here. We got another 25 basis point rate hike this past Wednesday. The message from the Fed didn't sound much different to me, and there was no mention of rate cuts, and it sounded like they were going to keep things as they were, potentially consider another one. So what are your thoughts there? I really feel like the Fed has been consistent with their messaging. They're not going to flip their strategy and run the risk that we saw in the late 70s and 80s, where inflation takes off again. I mean, it just hasn't been enough time for the lagging indicators to even catch up.
Right. Yeah, no, you're right, Jill. I mean, yeah, that's one thing about the way that we kind of operate now, that we are very short-sighted or attention challenged. So, yeah, you got to take some of these measures that the Fed has put in place. They take months, if not years, to slowly come to fruition. So that's another component here that we're going to see play out probably, because the Fed appears that, given the current environment, they are going to continue to be aggressive and maintain that tone that, hey, we're not cutting anytime soon, potentially raising if we continue to see challenges in the inflation front. We're seeing the right trends, but that could shift, in any given cycle. And the employment front continues to be very strong, but not at this point contributing too much to the inflation front. So really, the Fed continues to thread this needle. I think moving forward, they'll probably opt to be more aggressive because what you said about what took place in the late 70s, they don't want to make that mistake again. Even with the trend starting to show signs of inflation coming in quite a bit, we're going to get to a point where the comps are going to start to put pressure on those lower readings. And that will be a dynamic that the market hasn't even considered yet as we move into 2024.
All right. Appreciate the insight as always, Dan. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.